Is the S&P 500 ETF becoming too expensive, or is the market simply reflecting a new normal? Many investors are asking this question as the index continues to hit record highs, even while interest rates stay elevated. Let's break down what the data really says. In 2024, the US economy grew faster than most expected. Inflation cooled, but interest rates remained around 5%, keeping borrowing costs high and liquidity tight. Despite that, earnings have held up well. Corporate profits rebounded in sectors like tech and industrials, pushing the S&P 500's valuation back to pre-rate hike levels. This mix of resilient growth and limited rate cuts has created a unique market environment, one that challenges traditional valuation logic. As of October 2025, the S&P 500's forward price-to-earnings ratio sits near 21 to 22 times earnings, above its long-term average of around 17. At first glance, that looks expensive. But here's the nuance. Much of that premium comes from a handful of mega-cap companies, especially in AI, semiconductors, and software. When you exclude the top 10 stocks, the rest of the index trades closer to 16 times forward earnings, almost perfectly in line with history. So, the question isn't just whether SPY is expensive, but whether its concentration risk is. Compared to bond yields, the equity risk premium, the extra return investors demand for owning stocks, has narrowed to about 2%, one of the lowest in a decade. That means the market is pricing in optimism, moderate growth, soft inflation, and no recession. Still, history shows that valuations above 20 times don't automatically signal a crash, but they do reduce future returns. In short, SPY might stay strong, but it's unlikely to deliver the same 10% plus annual returns we saw in the 2010s. So, is the S&P 500 ETF too expensive? Maybe, but it depends on what you expect. If you believe the US economy can sustain moderate growth and AI-driven productivity continues to expand margins, then today's valuation isn't unreasonable. But if growth slows or inflation re-accelerates, this premium could quickly fade. For most long-term investors, discipline and diversification still beat market timing. SPY remains a core holding, but not one to chase at any price.